are you owing? So what I'm trying to say is, as an individual or a business organization, it is very possible to owe people or owe business organizations. Now, those debts that you are owing others is what we call liabilities. And we're going to be looking at double entry for liabilities. Liabilities are debts which the business owes other businesses or individuals. In a simple term, we can say liabilities are business borrowings for a particular period, regardless of the form it takes. What I'm trying to say is this: borrowings can take different forms and arrangements depending on the person borrowing and the person lending. Now, those borrowings that are in form of what? Debts that the business is owing is what we call liabilities. For instance, you borrowed money from the bank for business dealings, or you buy credits from suppliers for business activities. In a very simple form, any arrangement that involves owings or borrowings, it's what we call liabilities. Now, we understand that liabilities are what? Business debts or business borrowings. Classifying liabilities take two forms. What am I trying to say? We can classify liabilities into two: short-term liabilities or long-term liabilities. Short-term liabilities are liabilities or business debts that are due for settlement within a year. What I'm trying to say is, if you're owing an individual or you're owing other business organizations, but the arrangement is that the repayment of that debt or that owing or that borrowing, it's within a year, we refer to it as short-term liabilities. Short-term liabilities can also be called current liabilities. For instance, you're owing the bank for overdraft. Overdraft are usually a one-year arrangement, although it can be renewed every year. But so long as the arrangement says settlement is within a year, it is called short-term liability. So any liability that has similar interpretation to repayment or settlement within a year, it's called short-term liability. Now, long-term liabilities. We already explained short-term liabilities as liabilities due for settlement within a year. Now, when liabilities or business debts or business borrowings are due for settlements over a year, we refer to them as long-term liabilities. We can say long-term liabilities are liabilities that take over a year to settle or to pay. We can refer to long-term liabilities as non-current liabilities as well. For example, an amount owed to the bank for term loans. Term loans are usually loans that take more than a year to pay. It could be 3 years, it could be 5 years, depending on the arrangement between the bank and the person borrowing. So any borrowing or any arrangement of debt that will take more than a year to pay is referred to as long-term liabilities. Now, double entry application for liabilities. How do we apply double entry for liabilities? We already know what liabilities mean, but the idea is, before you apply, you must be able to interpret the transaction or the liability item to either be increasing or what? Decreasing in value. The first one here is liabilities increasing in what? Value. What we are saying here is that what? The value of a liability is increasing in value as a result of a particular what? Transaction. So what I'm saying is, in a particular transaction where liability is identified, the liability is increasing in what? Value. For instance, the supply of products or credit, what? 2 million received from what? A vendor. What are we saying? We are actually buying on credit from what? From a vendor. So in that case, our liability, which is the amount owed to the vendor, will increase by what? The 2 million. So where liabilities increase in value, the double entry application says we should what? Credit. What am I saying? Where we have our liabilities increasing, that liability item is usually what? Credited. Now the other one is what? Liabilities decreasing in value. What I'm saying is that as a result of the transaction, the value of what? The liability is what? Decreasing. For instance, if we paid parts of what? Of the goods that we bought on what? Credit. Remember? We bought goods worth 2 million on credit. Now, if we're paying part of it, say we're paying 1 million out of it, it will mean that what? The value of what? The liability, which is the debt owed to the supplier, will reduce by what? 1 million. So when liabilities decrease in value, they are what? Debited. This is a simple illustration or a simple diagram showing what we are talking about in the application of double entry for what? Liabilities. We already know that liabilities are what? Business debts to other individuals or other businesses, or borrowings from other businesses. So these are liabilities. For instance, you have creditors. Creditors are those that a business is owing or an individual is owing. So if you're owing Mr. A, Mr. A is referred to as what? As a creditor to the what? Business. And that is an example of what? Of liability. We have loans. If you borrow money from the bank, for instance, you're owing the bank. So the bank is seen as what? As a creditor as well. So in that case, that's a liability. We have overdraft. An overdraft arrangement is where the bank allows you to withdraw more than what you have in your bank account. In that case, if for instance you have say 1 million in the bank account and the bank allows you to withdraw more than that, that's an overdraft arrangement. So it's a liability because you are owing the bank. The next one is the debenture. The debenture here is more like an arrangement as well, to raise money from individuals or other organizations, such that what the repayment is over what? A particular period of what? Time at an agreed what? Interest. That's a simple meaning for what? For the debenture. It's more like a long-term arrangement. Because of that arrangement, we refer to it as what? As a liability. We have unpaid dividends. Unpaid dividend is simply saying, for instance, maybe a company declares dividend. Dividend is the part of the profit declared by a company to be paid to its shareholders. So if a company declares dividends and it's yet to be paid, it becomes a debt of the business to the shareholders. So such is a liability as well. Unpaid taxes. Taxes are compulsory levies, based on what? On status. A particular percentage. It could be on profit, could be on other what? Item that is payable to the government by what? By organizations. So where there's a tax on a transaction and it is yet to be paid, it becomes an unpaid tax, and that's a liability because the business is owing the what? Is owing the government. So whatever item it is, also interpret it to be a liability item. There are two things. It's either it is increasing in value or decreasing in what? Value. Where liabilities increase in value, we credit. Where they decrease in value, we what? Debit. Now, a brief illustration or example in identifying liabilities in what? In transactions. I would advise you to quickly go back to debit double entry application on assets and understand it, because when we do a proper illustration in our next class, we're going to be having transaction involving all of these items. So for this one now, which is double entry for what? For liabilities, we're going to be identifying the liability items in the transaction, and then we're going to know if it is increasing or what? Decreasing. So the first one I said, received cash from Mr. Taiwo as loan to the what? Business. Remember, if you receive loan from someone, it means you are owing the what? The person. So in this transaction, we can identify Mr. Taiwo, who is more like the loan, and then here, that's the liability item there. Cash is also an item here, but cash is not a liability, cash is an asset. So I've already explained in our previous class, that's double entry for assets, how to treat assets when they increase or what? Decrease. So here we are paying attention on the what? The liability items. So in this transaction, the liability item here is loan, which is loan to Mr. Taiwo. So if you are taking cash from Mr. Taiwo as loan, that would be an what? Increase in what? Liability, because before we collected the money from Mr. Taiwo, we're not owing Mr. Taiwo, that's zero. But now we are collecting money from Mr. Taiwo, that means what we are going to be owing in form of loan will what? Increase. So the liability item here is what? Loan, which is Mr. Taiwo, and it is increasing in what? In value. There's no liability item in decreasing here, so that's why we're making it dash here. The next one says bought furniture on credit from what? From Office Furniture Limited. There are two items here. Basically, we have furniture and then Office Furniture, which are the what? Which is the company that we bought from. But furniture is an asset, so you have to go back to our class and understand how to treat what? Asset items. But we have a liability item here, which is Office Furniture. That is creditor, because we are buying on credit from him, from this company. It means that what? We are owing this what? Company. So that's a liability. So liability there what? Will increase by the amount of credit that we bought from what? Office Furniture Limited. So we have creditor here, which is Office Furniture Limited, increasing in what? Value. No item is what? Decreasing. No liability item is decreasing in this transaction. Now, paid Mr. Taiwo part of his loan in what? Cash. Remember, the loan item that we borrowed, we had from Mr. Taiwo increased our what? Loan. Now we're paying part of it. When you pay part of it, it means that what? The loan item what? Decrease. So we have Mr. Taiwo here, which is loan item here, decreasing. So no liability item is what? Increasing. The last one says bought goods on credit from what? Clean Ventures what? Limited. So what do? We have credit here from who? Clean Ventures. So it means that what? Our creditor here will increase, which is Clean Ventures what? Limited. No item what? Decreasing. So that's the class on what? Double entry for liabilities. If you have questions, you can reach me on 081-36506-356 or send me an email, jeremiah.dosu@gmail.com.